When BlackRock's Larry Fink says tokenization of assets and securities will revolutionize finance, I believe it's worth a listen.
I actually believe this technology is going to be very important. We have been part of a huge revolution in investing through ETFs. We believe that ETFs will be changing the whole way we invest. The entire bond market is being transformed as we talk right now. I believe the next generation for markets, the next generation for securities will be tokenization of securities. Tokenization of securities.
Since the early days of blockchain, there's been much talk of the opportunities of tokenizing real-world assets, also known as RWA, and bringing them on-chain. And for good reason. Blockchains provide an easy, inexpensive, highly accessible platform for securitization of any assets. Now, unlike other securitization platforms, they also bring with them the benefits of DeFi, including immediate settlement, programmability, which can help automate things like trading and compliance, global markets, and composability, which can make it easier to bridge protocols and create innovative new products and services. Now, in a recent interview, Larry Fink, the chairman and CEO of BlackRock, one of the world's largest asset management companies, has declared that ETFs was a big revolution for the mutual fund industry. And we do believe that if we can create more tokenization of assets and securities, and that's what Bitcoin is, it could revolutionize, again, finance. Should Larry Fink be proven right and tokenization goes mainstream, its positive effect on the world of DeFi could hardly be overstated. Real-world asset tokenization is a process that involves converting tangible, physical assets into digital tokens or representations on a blockchain or distributed ledger technology. These tokens can then be bought, sold, and traded like cryptocurrencies, and they represent ownership or rights to the underlying real-world assets. This concept has gained significant attention in recent years due to its potential to transform the way we perceive, buy, and sell various types of assets. That is why we are seeing the rise of decentralized debt markets, and it's becoming one of the most significant developments in this space. Now, according to a recent Nansen report, these markets, which involve the issuance of debt tokens, have become the hottest use case for RWA tokenization, even eclipsing real estate. And here comes Goldfinch, a decentralized credit protocol that offers USDC yields for stablecoin lending generated by real-world economic activity, and as such remains more sheltered from DeFi's yield volatility. Further, by design, the protocol is constructed to help shelter participants from DeFi's volatility in the long term and to provide a more accessible, scalable alternative to traditional debt financing systems. It's a new and exciting concept that's set to disrupt traditional investment models and unlock new opportunities for investors. But before we'll explore how this RWA investment platform works, what makes it unique, and outline some of the risks associated with it, I want to welcome you to Crypto Never Sleeps. Now, in case you're new to crypto, then let me start off with the obvious. Get yourself educated as fast as possible, because this market is poised to take off. It is truly with great conviction and hard work that I try to provide you top quality projects like Goldfinch, which is currently trading at 96 below its all-time high. So do me a favor, hit the like, subscribe to the channel, join my live streams so that you can become among the top 1%. As I said before, my name is Nico Arachi and I'm the host of Crypto Never Sleeps. So what is Goldfinch? Well, for years the centralized sector has offered qualified businesses no collateral loans. Now, Goldfinch seeks to bridge this gap and service a growing niche via its proprietary system. Goldfinch seeks to bring crypto loans to the real world for its developers, and to that extent the protocol succeeds. Goldfinch was also built to expand access to capital in emerging markets. The network operates as pure code. Smart contracts and community governance systems replace bankers and loan officers. This approach is far more transparent, fair, and open. Consequently, more businesses are making the switch to decentralized lending protocols. The Goldfinch protocol remained more sheltered from crypto yield volatility seen across most of DeFi. So, when many traditional DeFi lenders offer attractive yield opportunities to their users, the return on investment being offered is usually generated by use cases tied to recursive on-chain actions tied to the performance of the wider crypto markets, dependent upon crypto price appreciation. Now, in contrast, Goldfinch enables lenders to take advantage of the yields crypto has to offer without being overexposed to DeFi's risk of a collapse in return of investment when on-chain volatility hits. As Goldfinch's USDC returns are generated by borrowers operating with real-world assets. Goldfinch stablecoin rates, protocol revenue, and borrowing volume are holding steady while many protocols are experiencing a decline in core yield metrics. And Goldfinch is able to do this by utilizing USDC, a stablecoin fully and transparently backed by real-world assets. Launched in 2018 by Center, which is a consortium led by Coinbase and Circle. USDC is a stablecoin pegged one-to-one to the USD and backed by cash and short-dated US government obligations, the reserve assets. Now, the reserve assets are managed by asset managers such as Blackrock and custody managers such as Bank of New York Mellon, who collectively manage more than $11 trillion in non-crypto assets, 50% of the US GDP. So how does it work, you might ask yourself? Well, the Goldfinch protocol currently has 3 different kinds of members. Borrowers are the first, are businesses looking to raise funding on the Goldfinch protocol and who propose borrower pools to the protocol to be assessed, including interest, terms, business performance data, and much more. Now, at this point, Goldfinch members must assess and decide whether to invest their USDC. The second group, bakers, provide risky first loss capital to these specific borrower pools in return for higher yields, whilst liquidity providers provide second loss capital to the senior pool from which capital is allocated to all successful borrower pools. In essence, liquidity providers take on less risk and also get less rewards. So let's look at liquidity mining of the senior pool. The liquidity mining protocol has 8% of tokens allocated as returns. Now, the goal of the system is to incentivize long-term liquidity providers and drive adoption. As a part of this strategy, the network has a 12-month lock period. After the period ends, your staked assets are returned plus your returns. You can then use your rewards and your staking part, of course, to improve your next staking round. And in case you just want to stake, well, users who want to secure passive staking returns can do so by staking their GFI tokens to particular backers. This process enables the network to improve consensus times. Additionally, whenever the staked backers join a borrower pool, the staked funds provide additional protection against default loans. This approach protects lenders from losses and keeps the protocol solvent. GFI is the main utility and community governance token for the Goldfinch protocol. The token serves various roles including staking, voting, and as a reward token. Additionally, all community grants and network incentives are paid out in the GFI token. And since November 1st, we have seen a remarkable surge in token value, actually more than 280% to be precise. Currently, the live GFI price today is trading around $1.41, and the current coin market cap ranking is number 584 with a live market cap of more than 40 million. It's not a lot actually. Trading at 95% below its all-time high, which was recorded on January the 11th, 2022. So this could potentially generate more than 2000% return on investment if it's going to hit its previous all-time high. Just remember, everything I say and do here should not be considered financial advice. You need to do your own research because in the end of the day, as you know, I don't know about crypto. Well, the main question you might be asking yourself is, So how is RWA-based lending different from traditional DeFi lending? And in short, protocols like Goldfinch introduce, for example, track record. And track record, let's say Goldfinch has already supplied more than 100 million of capital to fintechs and credit funds who in turn lend to fintechs across emerging markets and the United States. Those borrowers in turn are providing crucial services to their communities, local banks, who generally aren't willing to fulfill these criteria. Goldfinch borrowers have anywhere between 2 to 10 years of real-world track records, deploying capital for a wide range of productivity or productive users, from motorcycle taxis in Kenya to small businesses in Brazil to eco-friendly cook stoves for low-income households in India. This is just to name a few. And now I think it's time to look at some future price predictions in order to see what the sentiment is like. The first future price prediction comes from Trading Beasts, and they believe we're going to see a high in 2024 of $2.14 and $2.32 in 2025. The second one comes from Digital Coin, and they predict the price will hit $3.42 in 2024 and $4.80 in 2025. The last prediction comes from walletinvestor.com, and they're seeing a high in 2024 of $4 and of $7.11 in 2025. So that's it from me. I do hope you enjoyed this video, and in case it gave you any kind of value, then do me a favor, hit like, smash and subscribe and all them goodies. Come join the live streams when they're on, because I truly believe that you can benefit from them. The last thing I have to say is stay safe, stay home, don't think, because you know it can lead to depression. And don't forget, Kitty, she loves you.